markets we're at all-time highs, so that's a good thing, but we're not going up and down, not a lot of volatility, just kind of a flat week.
Calm market, no big announcements, and kind of just plodded along.
Right.
So staying steady.
It's interesting because you got China, you've got elections, you got this and that, and it's still just kind of going straight along, isn't it?
And last year, we lost 21% between September and Christmas Eve. So we haven't seen that big year-end correction.
Right.
And the market's up 24%.
Right.
So it's plodding along.
So you wonder, because if somebody were to say before the last election, and we all remember where we were then, there was a lot of problems back then, a lot of unrest, and somebody says, I'm pulling out. I'm going to cash. I don't trust this market. It doesn't like uncertainty, so I'm pulling back.
$3.3 trillion parked in money market.
Yeah.
I mean, that's a lot of pullback.
Yeah, it is.
That's a lot of money sitting idle, not making any money.
But if you did that, you missed a 40% run-up in the last 3 years.
Yeah, unbelievable.
Gosh. So, if that's your question right now about what I should do before the election, we can deal with that today. But one of the things is it can go up as easily as it can go down, so you have to position yourself for both sides. And that is kind of where we're going to go next. There is some people out there that are talking about this market and wondering, saying, okay, 10 years, 11 years now, we've been going up. Where does it end, or how do I position myself? This is Ed Yardini, and he's on CNBC, and he kind of sounds like he doesn't really go where to go.
I just don't want too much of a good thing here. I'd like this bull market to continue at a leisurely pace, not in a melt-up fashion, and I think that's actually the risk. I may have to consider taking some profits. I'd much rather just kind of stay fully invested in this bull market and not be forced to jump out just because it's ridiculously overvalued.
Too much of a good thing, ridiculously overvalued. What do I do? He sounds a little confused.
And he says he wants to stay fully invested.
Right.
And I don't understand why that's not an option.
Okay.
And I think people short themselves by thinking they need to time the market or back out. And when they back out, that means cash. And that's that $3.3 trillion we were talking about in money market. There's no reason to panic and push your money into cash. You're going to get burned. I mean, it's Murphy's Law. You're going to park it there, and the market's going to go up, and then you're stuck. I mean, think about the people that parked in cash at the end of last year.
Right.
If, God forbid, you sold on the way down and you panicked because we lost 10%, or you panicked when we lost 15%, or you panicked when we lost 20%, and you sold out, you lost 24% gains this year. Now where are you? You're stuck.
Yep.
Who's going to take that money in cash and reinvest it in the market at 24% higher prices than what you sold it at? So why don't we look at staying actively invested in the market and having enough asset class buckets to move to protection, but stay engaged in investing? And I'm not talking about fixed income. I'm not talking about money market. I'm not talking about CDs. I'm not even talking about bonds that don't pay anything and have long maturity dates to them. You can index invest. You can invest in potential market growth, and get protection. And the layers of protection will dictate how much growth they'll allow you to achieve in the market. So you're not going to get unlimited market growth and 100% protection in the market, but that's where you have different asset classes. And when we build our financial house and put retirement plans together, we clearly show you at a 10,000-foot level, here's what has 100% market protection against it. Here's a lower mid volatility. And then these are your higher growth, higher risk portfolios. And I draw it on the board in front of clients the first time I meet with them. The market's at all-time highs. Where do you think we are parking most of our client funds right now? We move them to the left in the financial house, which is 100% market protection or low, medium volatility. And then I draw another line way down low and I say, when the market corrects, and we don't know when, and we don't know by how much, but when it starts to correct, or we feel like it's getting to a bottomed out period, what will we do? We will move pieces from our protected portfolio and we'll get more aggressive with it. If you stop looking at the market day by day or month by month, and you start looking at at a minimum 2-year period, 3-year period, maybe even 5 years. I mean, think about retirement as a 30-year span of time, and you're going to watch it daily. You're going to be listening to somebody who says, I don't know whether I back out. I wish the market would go down a little.
You're going to go crazy.
You go crazy.
Yeah.
So, build your plan, Let your advisor watch the market daily, weekly, monthly, but do not knee jerk, do not react. And if you are in a position where you're panicking right now, it's because you're overinvested in equities and do not back into cash. Just massage it and move it to something that's protected, and you will lower your gain potential for sure, but you'll have 100% protection. It's your, put your head on the pillow and rest easy at night money.
One of the things I want to bring up here is, as you're talking about that, you're talking about someone who has an engaged financial advisor. You're talking about somebody who's watching over your money and working with it. I know that if you don't have that person and you have a 401k right now, for instance, and I'll just mention it's Vanguard. So I have money in Vanguard. They will only allow you to move money once every 3 months. So if you want to if you say to yourself, I'm nervous about this election, so I'm going to push more over to the cash area right now, you're stuck now. You can't make another move for 3 months.
Wow.
So if you have a 401k right now and you're in that position, you can't make these moves that Chris is talking about. And that is one of the things that we talk about, is getting this money under your own control in your own IRA, so you have all of these things to choose from and you have an engaged advisor.
Yeah, and you don't have the options as far as, even if it's after the 90 days, you don't have any investment choices that do what I'm telling you we can do at an advisory level, which is you can invest in indexes, potentially get market growth if the market keeps going up, but you're protected on the downside. They don't provide equity-linked CDs and 401ks, then they don't provide indexed annuities. Those are different products or asset classes that you should be considering if you are in your last, I say 10 years before retirement and first 10 years in retirement. Even squeeze it to in the next 5 years you're thinking about retiring. You've made a ton of money over the last 10 years. You better have made a ton of money. Otherwise, you're playing the I'm in, I'm out game. Mm-hmm. But if you've made 300% since the bottom of 2009 and you're staring at it, do not put it in cash. Roll it from your 401k into an IRA, hire an advisor, and make that advisor your protection person. Or leave a bunch of money in your 401k. But your 401k should be the S&P 500 index, period. I'll just call it out. It's the only thing that I ever recommend to my clients that come to me that have to leave some money in their 401k. Maybe it's age-based and they can't pull it out. Mm-hmm. They say, what should I do with my 401k? I said, I will protect and start generating income planning around your IRA money. Those target date funds, they're garbage. Mutual funds, they're going to underperform. This low fee, and we'll talk about 401ks later in the show, but I mean, if 401k companies are telling you they're managing your money and they're super cheap on the fee, you gotta wonder.
What are you getting for that?
Yeah, and what are the hidden fees there? So you gotta start to actively manage this. Look, I'm passionate about it. I love what I do for a living. I'm all about
Let's talk about it in the last minute or so here. Let's build a financial house. Protection, income, and growth. I mean, that's what it's all about.
Yeah, and right now everybody's stuck in growth. They're addicted to it. Mm-hmm. Even my own clients are coming in and questioning the models that we've created. Like, should we be more aggressive? Mm-hmm. Should we be in Disney? Disney's great. It's doing great. We have some of that in our portfolio. But Disney, Netflix, AMD just had good earnings reports and shot through the roof. They want to be in high growth. They're addicted to this market. And when you get to the end of a bull run or bull market cycle, don't get hooked on growth. You got to build two other things. You got to build an income plan, and you got to add layers of protection. So let us help you complete the portfolio, which looks like a retirement plan versus just a growth plan.
That's called the financial house, and that's what we offer to you each week on Money Unleashed.